Hi everyone! Welcome back to Australian Property Strategian, where we dive into all things real estate and investment. Today, we're tackling a question on many investors' minds. Is the Australian housing market in a bubble? We'll look at the key indicators, trends, and the risks involved if you're considering investing. So, let's get right into it. First, let's break down what a housing bubble actually is. A housing bubble occurs when property prices increase rapidly to levels that are unsustainable, usually because of demand, speculation, and sometimes loose credit conditions. Eventually, these prices can drop suddenly, leading to sharp losses. So, is Australia in that situation? To find out, let's start by analyzing recent trends in the housing market. In recent years, Australia's housing prices have skyrocketed, especially in major cities like Sydney and Melbourne. But other regions, like Perth, are starting to see their own booms. Let's look at some data. This graph shows the steady price growth across major Australian cities over the past decade, with prices spiking in 2021 to 2024, mainly due to low interest rates and high demand. Notice how Sydney and Melbourne lead the trend, but Perth and Brisbane has begun catching up recently in the past few years. This trend is more prominent with the low interest rates by the RBA in 2020. To understand if we're in a bubble, let's dive into the factors pushing up these prices. Three main drivers are low interest rates, limited supply, and high demand for investment properties. Australia saw record low interest rates during the pandemic, which encouraged borrowing and increased buyer activity. But rates have been rising recently, affecting affordability. As of October 2024, we are at 4.35%. Another issue is supply. There's a significant undersupply of new housing due to various reasons, including labor shortages and high construction costs. The labor shortage chart demonstrates a consistent rise in job vacancies within the construction sector over recent years, compounded by the COVID-19 pandemic. This shortage limits the workforce available for new housing projects, delaying construction timelines and driving up labor costs as demand exceeds supply. The shortage is further intensified by reduced immigration, an aging workforce, and competition from other sectors like mining. These conditions force developers to prioritize high-margin projects over affordable housing, exacerbating the scarcity of entry-level homes. The line graph on construction costs reflects steep price increases in essential materials such as timber, steel, and concrete. Global supply chain disruptions, inflation, and transportation costs contribute to this rise, as does the need for adherence to strict building codes and sustainability regulations. For developers, higher material costs mean increased financial risk, making affordable housing projects even less viable. Together, labor shortages and rising material expenses create a constrained supply environment, limiting new housing availability and contributing to higher property prices, conditions often associated with housing market bubbles. Lastly, the demand for investment properties remains high, especially as more people see real estate as a safer investment. This demand is further driving up property prices. As seen in this pie chart, in 2024, investors account for 40% of property purchases, marking a significant increase compared to the historical average, where around 30% of Australia's 11 million private residential properties are investment-owned. This rise in investor activity signals heightened confidence in the market and may contribute to increased competition for properties, driving up prices. With a larger share of purchases aimed at investment, affordability pressures could intensify for owner-occupiers. This shift also suggests investors expect strong future returns, despite rising interest rates and market volatility, underscoring the importance of tracking investor trends in assessing market stability. Now, do these indicators suggest a bubble? There are a few signs to watch out for: price-to-income ratios, rental yield trends, and buyer sentiment. Let's start with price-to-income ratios. The price-to-income ratio is a key metric for assessing housing affordability, comparing median property prices to average household incomes. A high ratio often indicates that property values are outpacing income growth, signaling potential overvaluation in the market. In Australia, this ratio has been climbing sharply, especially in major cities like Sydney and Melbourne, where property prices have surged while incomes have not kept pace. This rising ratio suggests a growing affordability gap, making it harder for average Australians to buy homes. As the ratio increases, the risk of a housing bubble becomes more pronounced, highlighting potential market instability. 40. The line graph of average rental yields from 2019 to 2024 shows a steady decline across Australia's capital cities. Rental yields, calculated by comparing rental income to property prices, often decrease when property prices rise faster than rents. This trend reflects the strong price growth in cities like Sydney, Melbourne, and Brisbane, which has outpaced rental income gains. Declining yields indicate that properties are becoming less profitable for investors focused on rental income, potentially signaling an overvaluation in the market. If yields continue to drop, investor interest might wane, impacting demand and potentially stabilizing or even lowering property prices. So what are the risks if Australia's housing market is indeed in a bubble? If prices are unsustainable, a market correction could occur. Let's break down the key risks. With the RBA raising interest rates, many homeowners are starting to feel the pinch. Higher rates can lead to mortgage stress, where borrowers struggle to keep up with repayments. In severe cases, this can lead to forced sales and downward pressure on prices. The following line chart shows interest rates versus mortgage stress levels from 2019 to 2024. As seen there, a sharp rise in mortgage stress in over 20% homeowners in 2024. If rental yields keep falling, investors could reconsider their positions, pulling back from the market as returns diminish. This reduced investor activity would lessen overall demand, potentially slowing price growth or causing a market correction. In a high-price, low-yield environment, fewer investors means less competition for properties, which could ease price pressures. Such a shift may help restore some balance to the market, possibly making housing more accessible for owner-occupiers. Global economic uncertainties, such as rising inflation and potential recession fears, pose significant risks to the real estate market. Inflation increases borrowing costs, affecting affordability, while recession concerns may dampen consumer confidence and reduce investment. These factors can lead to slower demand and stagnating property prices. Additionally, international market volatility may influence interest rates and capital flows, creating further unpredictability for both property investors and potential homebuyers. What should investors do? So, what does this mean for investors? Here are some strategies if you're considering investing in this environment. One option is to diversify your investment portfolio. While real estate can offer substantial returns, adding other asset classes like stocks, bonds, or commodities can help balance market fluctuations. This mix reduces exposure to any single sector's downturns, providing stability and growth opportunities across various market conditions. A diversified portfolio is often better equipped to withstand economic uncertainties, offering investors more consistent long-term gains. Focusing on properties with higher rental yields can be a smart strategy, as they often provide more stable returns during market downturns. Areas with strong rental demand, such as Melton in Victoria and parts of Perth, currently offer attractive yields due to affordability and growing populations. Investing in these regions may provide greater resilience against market fluctuations, ensuring steady income even if broader property values experience slower growth or corrections. Lastly, stay informed. The market is changing quickly, so keeping up with interest rates, rental yields, and other indicators is crucial. To wrap up, while there are indicators that the Australian housing market could be in a bubble, it's not a certainty. The best approach as an investor is to be cautious, stay informed, and make data-driven decisions. Thanks for watching, and don't forget to like and subscribe for more insights into Australian real estate. Let us know in the comments if you think we're in a bubble. Disclaimer: the information provided in this video is for general informational purposes only and should not be considered as financial or investment advice. We are not licensed financial advisors. Please do your own research and consult with a licensed financial, legal, or tax professional before making any investment decisions. Any opinions expressed are our own and not intended as specific recommendations.